Hello. Hello, Navya, am I audible? Now am I audible, Navya? Hello. Can you unmute yourself and tell me, Navya, please? Are you audible? Am I audible?
हॅलो
Yes, I can hear you. Who's that?
मॅडम तुमचा आवाज नाही येते.
नाही येत आहे, क्लिअर. एक मिनिट.
तुम्हाला आवाज येतोय मॅडम आमचा?
मला तर येतोय क्लिअर आवाज तुमचा सगळ्यांचा.
हॅलो
आता येतोय?
तुम्हाला आवाज येतोय का मॅडम?
जास्तच हे झालं. अरे बाप. एक मिनिट.
हॅलो नव्या.
यस.
आपको सुनाई दे रही मैम की आवाज?
नहीं.
नहीं ना. कल तो अच्छे से आ रही थी. कल मैम जो लॉ का मैम पढ़ा रही थी तो माइक का कुछ तो भी इशू है. अभी मैम ने चेक किया ना, अभी थोड़ा बहुत हिलाया तो आवाज़ आई थी थोड़ी.
हाँ.
हाँ मैम मैसेज भी नहीं देख रही है ना. मैम को बोली.
हॅलो. आता जरा आवाजाचा प्रॉब्लेम येतोय त्या मुलांना, टीम्सवरच्या मुलांना आवाज जात नाही क्लिअर.
हॅलो मॅम तुमचा आवाज आता येतोय.
ओके येतोय. ठीक आहे ओके, काही प्रॉब्लेम.
हॅलो
हॅलो, आय एम ऑडिबल नाउ?
आता येतो मॅम. तुम्ही ना
ओके.
मॅडम आता थोडं मागाशी ना.
काय?
हॅलो
हां बोल ना.
तुम्ही आता मागाशी ते माईकचं काहीतरी वायर हलवली ना,
हां.
तुम्ही चेक केला ना, तेव्हा पण आला आवाज. म्हणजे ते माईकच्या वायरचं काहीतरी प्रॉब्लेम आहे. ते मिस झालं ना की ते आवाज जातोय.
ठीक आहे पण आता येतोय ना? नाव आय एम ऑडिबल राईट?
तेच तुम्ही चेक केलं ना, तर म्हटलं तुम्हाला सांगावं एकदा की
ओके,
ते काहीतरी
we'll
हलवलं की
start now.
आवाज येतोय बरोबर. हो चालेल मॅडम.
Now we will be discussing today regarding price discrimination. So what we saw, in which type of market is price discrimination possible, Navya, Shaila? We saw different types of markets, right? Perfectly competitive market, oligopoly, monopoly, monopolistic competition, duopoly, right? So what do you think, in which type of market we studied that price discrimination is possible? Monopoly, right? In a monopoly market, like a doctor, he can do price discrimination between various segments of people, right? So price discrimination is possible in monopoly market because he is the only person who will, there is no other substitute to his service or good, and he is the person who will be single person who is supplying the goods or service, and there is no substitute for that also. So we have to take that goods or service from that specific person only, so he can do price discrimination. In a monopoly market, we saw that price discrimination is possible. So we are discussing price discrimination. So see what we studied previously. When the price increases, the demand for that commodity decreases. So price and demand are inversely proportional. But when the price increases, the supply for that commodity also increases. Why? Because as a supplier, if I am supplying the goods, price is increasing. If I supply more, I will get more profit at that price because price is higher. My profits will increase. So when the price increases, supply also increases. So price and supply have a direct or proportional relationship, and price and demand have an inverse relationship.
चली आवाज
Right? So we are discussing. Hello? Huh?
आवाज नाही येते मॅडम, परत आवाज गेला.
शैला तर त्याला काय करू मला I think there might be problem from your side because every time it's happening, and proper internet speed is also fine and the sound system is also fine, so I'm not clear whether it is an issue from your side or not. Hello? So what we studied is an equilibrium price, right? So firstly, price discrimination is possible in a monopoly market by the monopolist. Price and demand have an inverse relationship, while price and supply have a direct relationship. Equilibrium price is the constant or unchanged price where the demand of the commodity is equal to the supply of that commodity, right? The demand of that commodity is equal to the supply of that commodity at an equilibrium price. So we will see how it is happening. So price discrimination. In a perfect situation, price is decided by the market, right? In other forms of market like monopolistic competition, oligopoly, or other forms of market other than monopoly, what we saw, the price will be decided by the market factors like the demand and supply. If the supply is more, demand is less, price will be low. If the supply is less, demand is high, price will be high. So these market factors, that is the demand and supply, will help in determining the price. It means the forces of demand and supply determine the price of the good. Now we are discussing about the equilibrium price. Equilibrium price is established at a point where supply and demand are equal. We saw here, see, demand is equal to supply of the commodity, where the demand for the commodity is equal to the supply of the commodity. That point of output, whatever will be the price, is the equilibrium price. Okay. Now we will see further what they are saying in this table helps to understand the changes in the supply, demand and equilibrium price. See, when the price is increasing, demand is falling, right? So inverse relationship, demand is falling. So price and demand have an inverse relationship, with inverse relationship. When the price is rising, quantity supplied is also increasing.
Hello, Novya.
Hello? When the price is rising, quantity supplied will also rise. Why? Because we saw previously, as a supplier, if the price rises, I will supply more because I want to get more profits. So price and supply have a proportional or direct relationship.
रुको, मैं दीपा मैम है ना, उनसे पूछ के देखती हूँ एक बार. कल तो पूरे टाइम आवाज अच्छी थी, मतलब ब्रेक ही नहीं हुई. कुछ तो भी माइक का इशू है.
Now what we are seeing, the above table shows that demand and supply schedule of good. Changes in the price always causing a change in the supply and demand. As the price increases, there is fall in the quantity demanded. So price and quantity demanded have an inverse relationship. It means price and quantity demanded have a negative relation, that is an inverse relationship. But rise in the prices has increased the supply of goods. When the price rises, the supply of goods increases, right? Why? Because the supplier will get more profit, so he will supply more when the price is huge. So the price and supply will have a direct or proportional relationship. The relationship between price and supply of goods is positive. Every time a change in price is causing some change in the supply as well as demand. At one price rupees 3, it can be observed that the quantities supplied and demanded are equal. See, at price 3, the quantity demanded is 30 and the quantity supplied is also 30. So the quantity demanded of that good is equal to the quantity supplied of that good at price 3. So the price 3 is the equilibrium price. This is called the equilibrium price. You see in this figure 2.10, when the demand and supply both are intersecting, at that price 3 is the equilibrium price. In the above diagram, demand and supply are shown on OX axis. Price is shown on OY axis. In the diagram, DD is the demand curve and SS is the supply curve.
Hello Navya.
Both curves intersect at point E. It means the demand and supply are equal at ON. So the equilibrium price is determined as OP.
Hello Navya.
Yes? Hello?
हॅलो, आवाज नाही येत मॅम तुमचा.
मगाशी मी विचारलं त्यावेळी तुम्ही म्हटलात येतोय. एक मिनिट आपण परत प्रयत्न करू. एकच मिनिट.
मी दीपा मॅडमांना कॉल करून सांगितलं मॅडम.
हां
तर कोणाला तरी पाठवतायत वर.
ठीक आहे ठीक आहे ओके. आवाज टीम्स वाल्या लोकांना जात नाहीये. टीम्सवाल्या लोकांना आवाज जात नाही टीम्सवरती. हे जे शैला आणि नाव्य आहेत ते म्हणतात आवाज येत नाही आम्हाला. हां मी पण तेच म्हटलं. ठीक आहे कंटिन्यू करूया. तुम्ही यूट्यूब यू कॅन सी इट ऑन यूट्यूब इफ देर इज एनी प्रॉब्लेम फ्रॉम युअर साईड बिकॉज एव्हरीथिंग इज फाईन फ्रॉम आवर साईड. वी हॅव चेक्ड एव्हरीथिंग. Yes, yes, come. It's a full speaker. सेटिंग्स मध्ये पण बघितलं मी. लँग्वेज अँड स्पीच ऑडिओ सेटिंग्स ठीक आहेत. ऑडिओ सेटिंग्समध्ये काहीच प्रॉब्लेम नाही आहे आपला. नाही येत. नाही ते त्यांना बोलायचं असेल ना तर ते चालू करतात ते. हे तर व्यवस्थित आहे. हे बघा, हे फुल आहे आपलं, हे स्पीकर पण ऑन आहे आपला, ऑडिओ इंटरफेस पण चालू आहे. नाही, हे ऑडिओमध्येच आहे ना, आवाजाचाच प्रॉब्लेम आहे. बाकी हां, हे तर ठीक आहे. स्पीकर चालू आहे, हे फुल आहे, हे पण चालू आहे, मायक्रोफोन नाही आहे काही इश्यू इथे. त्या दिवशी पण दीपा मॅम तेच म्हणत होत्या, इश्यू आहे त्यांच्या साईडनी काहीतरी प्रॉब्लेम. हॅलो, नाव इज इट ऑडिबल शैला? हॅलो, नाव्या अँड शैला, आय एम ऑडिबल नाव? हॅलो, रिप्लाय पण देणार. हॅलो, आय एम ऑडिबल नाव, नाव्या अँड शैला? आय थिंक मी कंटिन्यू करते, यूट्यूबवर बघतील आता काय करणार. नाही, याच्यावर पण सेटिंग्स व्यवस्थित आहेत. लास्ट लेक्चरला पण तसंच झालं ना, दीपा मॅम म्हटलं आपल्याला की आपण काहीच करू शकत नाही, काहीच करू शकत नाही करतो. हां, ते करू शकतो, पण करते मी कंटिन्यू. ठीक आहे, बघूयात आता. Price discrimination under monopoly. We saw in monopoly there is a single seller and he only determines the price for his goods or services. There is no other substitute for his goods or service. He is the only single seller of the goods or service. So he can determine the good price for his goods or service. So while doing to maximize his profit, monopoly will follow price discrimination. He will charge different prices for different segments of customers. See, if the seller charges different prices for different customers for the same goods or services, it is said to be price discrimination. In which market is price discrimination possible, Piyush? In which market? We saw perfect competition, we saw oligopoly, we saw duopoly, we saw monopolistic competition, we saw monopoly. In which market? Only one market price discrimination is possible. Yes, right. It is possible to have price discrimination only in monopoly market. Hence it is called discriminatory monopoly. Now we have classification of price discrimination. Professor Piyuk has classified price discrimination into 3 types. We have 3 types: price discrimination of first degree, price discrimination of second degree, and price discrimination of third degree. So price discrimination of first degree occurs when the monopolist charges the different price for the same goods or service to different segments of people. What means different segments of people? Means poor, middle class, rich. So he will be charging different price to a poor person, to a middle class person, and to a rich person. That is called the different segments, charging different price to different segments of people. If the seller charges different prices to different customers on the basis of paying capacity of the consumer, it is said to be price discrimination of first degree. It is on the basis of paying capacity, right? Poor has low paying capacity, so price will be less. Rich has very high paying capacity, so price will be higher. Middle class people have an average paying capacity, so the price charged will be average to them. Price discrimination of second degree. So what happens in price discrimination of second degree? We are not doing price discrimination on the basis of segments of people or their paying capacity. We will be charging price discrimination on the amount of quantity of goods purchased. See, if you go in Pimpri and you buy a dozen of kurtis or dozen set of anything, you will get it at a low price, but you have to buy the dozen, right? So that time they will give you discount. So price discrimination of second degree is similar to that. When you buy in a large quantity or you purchase in large quantity, that time you will get lower price. But if you buy normal 1-2 pieces, you will be charged high price. That is price discrimination of second degree. See, in this case, the seller charges one price up to a limit of goods purchased. See, what they say, if you purchase up to 1000, we will 1000 rupees of goods. If you make purchases up to 1000 rupees, we will charge you 10. But if you purchase up to 2000, we will charge you 8 rupees or 8.5 rupees. So if you purchase in large, the price will be low. That is the scenario here. Seller charges one price up to a limit of goods purchased. After that limit, he charges another price. It is called price discrimination of second degree. It is also known as block pricing. We are blocking the price. We are blocking an amount rate. Up to 1000 rupees, this price. Up to 2000, above 1000 rupees, this price. So we are blocking that 1000 amount to determine our price for goods and services. So it is called as block pricing. Price discrimination of third degree. So price discrimination of third degree states that whenever we do a price discrimination, we don't do either on the basis of different segments of people or neither on the basis of a particular block price. That price is known as price discrimination of third degree. It is based on the elasticity of demand of that particular product. So we will see. Irrespective of the paying capacity of the consumer. So we will not take into consideration the paying capacity of the consumer and the quantity of goods purchased. We will also not take into consideration the quantity of goods purchased. If the seller charges different prices, it is called price discrimination of third degree. The market of the product are made different on the basis of differences in the elasticity of demand of different markets. It is based on the elasticity of demand of different markets. Now we will see conditions for price discrimination. What are the conditions for price discrimination? We will see that. Let's do this. इलॅस्टिसिटी वरती बेस्ड आहे बेसिकली. इलॅस्टिसिटी ऑफ डिमांड ऑफ डिफरंट मार्केट्स. त्या प्रोडक्टची इलॅस्टिसिटी कशी आहे त्याच्यावर डिपेंड आहे. म्हणजे प्रोडक्ट जर इनइलॅस्टिक असेल, म्हणजे प्रोडक्ट जर डिमांड रिस्पॉन्डच करत नाही प्राईस, तर त्याची प्राईस आपण काय करू शकतो, हाय ठेवू शकतो की नाही. आणि पण जर डिमांड रिस्पॉन्ड करत असेल जास्त टू द चेंज इन द प्राईस, दॅट टाइम वी कांट इन्क्रीज द प्राईस मच. It is based on elasticity of demand of different markets. Inelastic and elastic demand माहिती आहे ना तुला, त्याच्यावरती based. So conditions for price discrimination. A monopoly firm can sell the same product at two different prices to two different groups of buyers. This type of price discrimination becomes possible under following circumstances. We will see what are the circumstances. Different price elasticity of demand. See, if the price elasticity That is two cases. Either it can be inelastic or either it can be elastic. Inelastic demand, elastic demand. See, if it is inelastic demand means what? Even if we change the price, demand will not respond much, right, Piyush? Demand will not respond much. If the demand is not responding much, we can change the price as we want. We can keep the price high for inelastic demand. For elastic demand, what happens? Demand is more responsive. Means if we change the price, the change in the demand is huge, right? So the demand gets impacted by the change in the price much. So we will keep here the price low. So these are the things. So when the price elasticity of demand is relatively inelastic, the monopolist will keep the price high. And on the other hand, if he charges relatively lower price in the market where the price elasticity of demand is relatively elastic. Piyush, you got it? Why for elastic demand, what type of price we charge as a monopolist? In elastic, demand is more responsive or less responsive? Inelastic, the demand is more responsive. So if we change the price, demand will fall immediately if we increase the price. So we can't increase the price much, right, Piyush? So we will keep the price low. Inelastic, what happens? Demand is less responsive. Means even if we increase the price, demand will not fall much. So we can increase the price, right? Tariff barrier. So what is a tariff barrier? Tariff barrier refers to the taxes which are imposed on that particular good or service. So these may change during the country for the foreign market and the Indian market trade. So that will also impact the price discrimination. We will see how it is impacting the price discrimination. So in the domestic market and in the foreign market, due to tariff barrier in the domestic market, we charge a higher price, and in the foreign market, the monopolist charges lower price. If two markets are separated by a tariff wall, the monopolist can follow the principle of price discrimination. The monopolist can sell its product at a lower price in the foreign market and higher price in the domestic market. Why? Because in the domestic market, the tariff barrier will be, taxes are usually high, and so that increases the price. We will charge a higher price in the domestic market and lower price in the foreign market. Now again, geographical distance between the markets. Price discrimination is also possible when two markets are separated from one another by geographical distance. See, I am selling a good in Pune market, and that same good in far away in Delhi. So the distance is huge. Pune market will be a local market for me, and the Delhi one will be a distant market, right? So what will happen? In the local market, I can charge higher prices, but in a distant market, I have to charge lower prices. So they are saying the same. In this case, the monopolist can sell its product at a lower price in the distant market and at a higher price in the local market. Next comes impossibility of resale of the product or particular service items. See, if I provide a goods or service to you and you again cannot resell it, then I can use price discrimination more. See, doctor, as a doctor I am providing service to you. Again, can you provide that same service to another person as you? No. Same medicines I will, you have fever, you came to me, you have fever. I gave you some medicines and you found that someone of your relative also has fever. So, will you again say, I will be your doctor and you will write that prescription of same medicines and take money from that your relative? You can't do that, right? You cannot sell the service again. In case of goods also, if the goods are not resellable, the price monopolist can perform price discrimination. If it is not possible on the part of any buyer to resell the product sold by the monopolist, then the monopolist can easily follow the policy of price discrimination. This happens particularly in case of service items. Which point? You did not get it. See, if I am not able to sell the product again, product or service, I give that product or service to you, and you again cannot sell it to another person or provide service to another person, then the possibility of price discrimination of the monopolist is huge. Clear? That is the case. See, here is an example. A renowned doctor can charge different fees for rendering similar services to two different patients. And in case of doctor, is it the service resellable? Can you again provide that service? I provide it to you. Can you go and provide it to some other person? No. So, there is a monopoly of that service, which is anyone cannot perform it. So, that's why there is price discrimination by the monopolist. Ignorance of consumers. What does it mean by ignorance of consumers? See, I know this particular product or this particular service is available at a particular price in the market. That is known as I have the knowledge of the market. But ignorance by consumers means what? Consumers either don't know clearly what is the price for the same quality of the good in the market. This lack of knowledge is known as ignorance by consumers. If they don't have the proper knowledge of the market, what price, what quality the particular quality product is available at a particular price in the market, they do not have the knowledge of the market or they are ignorant, that gives the monopolist a chance to perform price discrimination, right? If I know that the particular quality product is available at a particular price in the market and you come and charge a higher price to me, what will I do? I will not take that service, right? I will go and go at a place where I know that the particular quality product is available at that price, lower price, I will go there, right? So that is ignorance of market or lack of the knowledge of the market. So when the buyers have ignorance in the market or lack of knowledge of the market, that time the monopolist can perform price discrimination easily, right? If I have the knowledge of I don't have the knowledge of the market, I will take that product from. But if I have the knowledge of the market that a particular quality product is available at a particular price and you come and charge me more price, very high price, in price discrimination, monopoly will charge high price, right? So you come and charge me high price. But when I have the knowledge of the market, I will not take that service from you. Will I take? No. I have the knowledge of the market. I will go at that place where I know that same quality product is available at a lower price. That is known as ignorance of consumers. If the consumers remain ignorant about the differences in the prices of same product in two different markets, then also the monopolist can easily follow the policy of price discrimination, right? Next is typical behavior of consumers. Here they are saying what is the typical behavior of consumers or Veblen effect is that when I see that the price of a particular product or service is high, what I think that it is a quality product. That is known as Veblen effect. Normal tendency of a consumer is what? If the price is high, the quality will be good. That is the tendency of a consumer, or that service will be good. Product or service will be good. But it may not be the same in every case, right? Even though the price may be high, the quality may or may not be good, right? It may not be good also, right? Every time if the price is high, will the quality be good? Is it required? No. In some cases, even though if the price of the product is high, it may not have that particular quality what it is required. So this tendency of the consumer that high price is good quality motivates the monopolist to perform price discrimination and charge higher price with the buyers. In some cases, a group of consumers consider higher price as an indicator of higher quality. Some consumers think that higher price is higher quality. So that is called the Veblen effect. Such typical behavior of the consumers creates an opportunity for the monopolist to follow the policy of price discrimination. Just a minute. Okay, this is fine. Okay. Now next are, what are the conditions when price discrimination is profitable? We will see what are the conditions in which price discrimination is profitable. Price, what will be the monopolist's intention? Profit maximization. So he has to perform price discrimination in such a way that it helps in profit maximization. See, price discrimination, though possible in many situations, need not always be profitable. So there are some conditions in which price discrimination is profitable. The objective of price discrimination is to maximize personal profits of the monopolist, right? Assume that firm produces a single plant and supplies it to markets. We are seeing an example. There is a company who produces goods in a factory and supplies those goods in two different markets, in India and in US market. Okay, he sells its products in India as well as in US. Okay, we have to determine the amount of sale and price in each of the markets so that the total profit is maximized. Okay, suppose the markets are 1 and 2. India is 1, USA is 2. Okay, R1 and R2 are the sales revenue from the two markets. What they are saying is that R1, this is the revenue, this is the revenue. Okay, and Q1 and Q2 be the amount sold in these particular markets. Q1 and Q2 are what? Quantity of goods sold. This is the revenue per unit. Now how we will determine the total revenue here of India and US? We will multiply the quantity into the revenue. Selling price into quantity will give you the sales, right? So R1 into Q1 and R2 into Q2. These are the revenues of both the markets, right? Now we will see what is cost here. See, they wrote R1 is equal to R1 into Q1 and R2 is equal to R2 into Q2. These are the revenues of the two markets. Let's see with the total cost of production. This firm is supplying both in India and US. It has a particular cost of production which is C. So again, for cost of production, how we will determine? Cost per unit into cost per unit into quantity, right? So what is this cost? Whatever be the cost per unit into the quantity, that is Q1 plus Q2. Okay. Now we will see, we saw what is the revenue. Total revenue will be what? Adding the revenue of India plus US will give us the total revenue, right? And cost is total cost only we have determined here, C into Q1 plus Q2, right? Now what will be the profit? Profit is equal to R1 into Q1, revenue of Indian market plus revenue of US market minus the total cost, C into Q1 plus Q2. Clear, Piyush? We got the profit. So what we saw, on what factors will the profit depend? Mostly on the quantity sold. If the quantity sold is high in that particular market, we will get more profit from that market. Now, what are the basic conditions for price discrimination to be profitable? See, we saw there were two conditions for equilibrium, right? Marginal cost is equal to marginal revenue, and the marginal cost curve cuts the marginal revenue curve from below, right? So the same conditions will be applicable here for profit maximization in price discrimination. So the two conditions for profit maximization in price discrimination are, first one is marginal cost is equal to marginal revenue, and the second one is marginal cost curve cuts the marginal revenue curve from below. Okay. Same they are given. The necessary condition for profit maximization is the equalization of marginal revenue in the two markets with single marginal cost. That is, marginal revenue is equal to marginal cost and marginal revenue 2 is equal to marginal cost, right? Marginal revenue should be equal to the marginal cost. Condition 1 shows that monopolist will produce for the first market at such a point when the extra revenue from the sale of one extra unit in the market is equal to the extra cost of production. What does this mean is that if we increase the quantity of production by 1 unit, for producing that one extra unit we will require some extra cost, and for producing that, after selling that one extra unit, we will get some extra revenue. So whatever will be the extra cost and the extra revenue, both should be equal. At that point only he can maximize the profits. Second condition explains the optimum sales quantity in the second market is such a point that extra product cost from extra production can be exactly be recovered by one extra unit of revenue from the market. So what is the combining 1 and 2? We get marginal cost or revenue 1 is equal to marginal cost revenue 2 is equal to marginal revenue 1, marginal revenue 2 is equal to the marginal cost. That is, marginal cost is equal to marginal revenue. This is the first order condition for profit maximization under a common form of price discrimination. The sufficient or second order condition is that the respective marginal revenue curve will have lesser slopes than the marginal cost curve. That is, the marginal cost curve will cut the marginal revenue curve from below. So Piyush, what are the two conditions for maximization of profit in price discrimination in a monopolist market? Can you tell me? Marginal cost is equal to marginal revenue, and the marginal cost curve cuts the marginal revenue curve from below. Means cuts from below means what? Marginal cost is less than the marginal revenue. It is down. Cutting from below means what? Marginal cost is down, marginal revenue is up. Cost will be less, revenue is more. Clear? In the following diagram, figure 2.11, the profit maximizing levels of output and prices are determined under third degree of price discrimination. What was third degree of price discrimination? It was on the basis of elasticity of demand in the market. So we will see how it does. The horizontal axis of the third plot measures the total quantity of production, that is Q is equal to Q1 plus Q2 and sale. See now, in the first and the second part of diagram, what we can see? The equilibrium of market 1 and 2 are shown respectively. These are equilibriums. E, E2 and E. These are the equilibrium. So what is equilibrium, Piyush? So normally where do we have equilibrium? When the quantity demand. What is equilibrium price? When the quantity demanded of that product is equal to the quantity supplied of that product, at that point of output we have the equilibrium price, right? Equilibrium price is equal to quantity demanded of that product is equal to the quantity supplied of that product. That price is the equilibrium price. Clear? See, I'll show you now. See on the screen. See, this chart you can see. In this chart, what is happening? The price is increasing, right? And what is happening when the price is increasing? Quantity demanded is what? Falling. Is it increasing or falling? Price is increasing. What will happen to quantity demanded? It is falling. When the price will increase, demand will fall, right? And when the price is increasing, what is happening to the quantity supplied? Increasing. Because as a supplier, when the price will increase, I will supply more because I will get more profits. So at price 3, what you can see? 30 is the quantity demanded and quantity supplied is also 30. So quantity demanded is equal to quantity supplied. So price 3 is the equilibrium price. Now clear? नाही प्राइस सेम नाही, प्राइस काहीच नाही. क्वांटिटी डिमांडेड इज इक्वल टू द क्वांटिटी सप्लाइड. त्या प्राइसवर आपण ती प्राइस इक्विलिब्रियम प्राइस आहे. प्राइस सेम नाही राहणार कुठेच. प्राइस सेम नाहीये. क्वांटिटी डिमांडेड इज इक्वल टू द क्वांटिटी सप्लाइड. At that particular point of price, we say that price is a equilibrium price. आता कळालं? हे तू मिस केलंस ना, त्यामुळे झालं. Now we got the equilibrium price. E1, E2 and E are the equilibrium prices in this diagram. So what we are saying? In the first and the second part of the diagram, the equilibrium of market 1 and 2 has been shown respectively. The last part of the diagram explains the equilibrium of the monopolist in total or aggregate framework. Last is the third diagram, which what it shows equilibrium of the monopolist in aggregate it is showing. Aggregate means both. Diagram 1 and diagram 2. Both aggregate, it is showing as equilibrium. The demand curve in one is less elastic than 2. What we are saying is that the demand curve in one is less elastic than 2. Means what? Elastic means what? Demand is more responsive. In one it is less elastic, in two it is more elastic. So we can say in one it is inelastic, less elastic now, so we can say inelastic, and here we can say elastic. Okay, so now we will see what they are saying again further. The corresponding marginal revenue functions are MR1 and MR2. They are saying the marginal revenue functions are MR1 and MR2. These are the marginal revenue functions. By adding them horizontally, we arrive at the common marginal revenue. If we add up both markets' revenue, we will get a total of the revenue of both the markets, right? That is MR. The monopolist is in equilibrium at E when marginal revenue is equal to marginal cost. We saw what is the condition for profit maximization in monopolist market. Marginal revenue is equal to marginal cost, right? So at point E there is happening that marginal revenue is equal to marginal cost. Corresponding to that equilibrium in aggregate, E1 is the equilibrium of the first market when marginal revenue is equal to marginal. At E1 of the first market, marginal revenue is equal to the marginal cost, and at E2 in the second market, again the marginal revenue is equal to the marginal cost. The corresponding price in market 1 is P1 and quantity sold is Q1. See, this is the P1 is the price and Q1 is the quantity sold. And for market 2 there are P2 and Q2 are the corresponding prices, right? The aggregate quantity sold is what? Combining both the quantities of the market, Q1 of the first market, Q2 of the second market. When we add up, aggregate these quantities, we will get the total quantity sold, right? We see that P1 is greater than P2. What we are seeing? Price in market 1 is greater than price in market 2. Why? What is market 1? It is inelastic. What does inelastic mean? Demand is less responsive. Means even if we increase the price, even if we keep the price high, demand will not be impacted much. So we can keep the price high, right? So here in market 1, P1 is high, the price is high. And in P2, the demand is elastic. Elastic means what? The demand is more responsive. More responsive means if we increase the price, demand will fall, and we don't want that, right? Demand will fall, so we cannot keep the price high, right? So the price is low in market 2. That is only said. Note that high pricing charged in market 1 because of inelastic nature of the demand and lower price for relatively elastic demand for market 2. Clear, Piyush? So now with this we have completed the topic of price discrimination. You are clear on that equilibrium price, Piyush? Where at a point where the quantity demanded is equal to the quantity supplied, at that level of price, that price is called the equilibrium price. Price is not equal anywhere, okay? We will take a quick break. Piyush? Okay, 5 minutes break we will take. Completed one chapter, right? One topic. Now take some break. Huh? Price discrimination संपला फक्त दुसरा कसा? तो आधीच संपलेला होता. we'll see what is the introduction to money and banking. See, what is money and banking? I am the person who is earning money, right? So, if I am earning 50,000 rupees, I will have some expenses, right? Say my expenses are 30,000 and 20,000 rupees I am saving every month. Okay? If I am saving 20,000 rupees, that amount will be with a bank, right? In my account every month, that amount will reflect as a balance, and those are my savings. What will bank do of these savings? Bank, those a person who wants loan, bank will use this my balance money to give loan. That is known as the banking system, how it is working, right? That money will be used to give loan to another person, right? So that is how the banking system work in commercial banks. Now we will see that they are saying that there is the banking system. So in any economy, households save money from their income after consumption and put savings in financial institutions like commercial banks. On the other hand, businessmen are the investors who borrow funds from the commercial bank, right, Piyush? So the financial system is defined as an institutional arrangement through which funds are mobilized from the savers transferred to the investors, right? The money market is an institutional arrangement for the transaction of short-term funds or short-term financial assets which mature within 1 year. Vis-a-vis the capital market where long-term funds and assets are transacted. Now what they are saying, government of the country. What is the role? We saw savers save money, they put it in the bank. Require person who wants money, borrows money, that money from the bank. Right. Now what is the role of the money in this banking or financial institution sector? We will see that. What they are saying, when there is recession in the market, recession means what? There is no demand for the goods or services. Mandi, what we say. That is known as recession. Means even though the supplier are producing the goods, there is no demand is very low in the market. Okay? So when the demand is not there, supply is high, demand is less. So what will be the price of the goods? Low, right? Demand is low, so the price will be low. So in this case, the price is low. People have less money with them, so only they are not buying, right? If they would have more money, there would have been demand, right? They have less money, so they have less purchasing power, so the demand is less, right? So people have less money in their hands. So to give money in the people's hand, what the government will do, it will reduce the interest rate in case of recession. So when the interest rate is less, what will people do? People can easily borrow the money at lower rate, so they will borrow more, right? When they borrow more, they will get more money in their hands, so the purchasing power will increase. Purchasing power increases, in turn what happens? Demand will increase. Demand will be boosted and our problem of recession will be solved, right? Now second case scenario, in inflation, what will be the government do? Inflation means what? Price of commodity, price of goods and services is high, right? So price is high. In which case price is high? When the demand is more but the supply is less, in that case we have the price of the commodity high, right? So demand is more, people have more money in their hands. Now what the government should do? Government wants to reduce the money in the people's hand because supply is not that much. So to reduce that money in the people's hand, they will increase the interest rate. Interest rate will be increased by the government. So what will happen? If the interest rate is high, people will not borrow more money from the banks. People will not borrow more money. So the money available with them will be less. So what will happen? That demand will also decrease. So demand will be controlled. Demand will be brought to the level of supply. So got it? How the government plays the role in controlling the recession and the inflation in the economy. That is only they have explained it here. The government of the country enforces monetary policy through the financial system. For instance, when there is recession in the market, the government brings down the interest rate to allow credit to be given liberally to the producers. Similarly, at the time of inflation, the interest rates are increased and credits are controlled. Is clear on the concept? Now we will move further. What are money and its features? You know, money is a medium of exchange, right? Acceptable medium of exchange, right? But previously in the ancient times, before money, we were using barter system, right? Exchange of goods for goods, exchange of goods for services. Right, but what were the problems when we didn't have money? Why there was a requirement to print money by the government? Because that only we will be seeing what drawbacks the barter system had. So there was a need to print money and create a standard payment for all the people. Okay, standard means of currency for all the people. So we will see what are those. Money, types, features and functions. Before the introduction of the money, barter system was in vogue or prevailed. It is an old method of exchange. People used to exchange services and goods for other goods and services in return. So what were the difficulties in this barter system? Lack of coincidence of wants. What does lack of coincidence of want mean? Coincidence of want means what? I want to purchase rice from you and you want to purchase wheat from. So both should have that want, right? You should also, only if I want to purchase rice from you, will the transaction happen? Will the transaction happen? You should also have the desire to purchase. If at your house you have wheat in large quantity, will you purchase wheat from me? It is a perishable good, right? If you have large amount of wheat with you, will you purchase it from me? Even though I want to purchase rice from you, you will not purchase wheat if you have more amounts of wheat, available amount of wheat with you at your home, right? So both should have the same want, right? Only one person, in case of money, what happens? If only I want to buy rice from you, and then what will happen? I will take rice from you, I will give the money. But in case of barter system, the problem was only one person's need is not sufficient. Both the person should have that need, right? Only I want to purchase rice is not fruitful. You also want to purchase that wheat. If you have the available wheat at your home, you will not purchase wheat from me, right? So both the person should have the want and for want of that specific good, right? That was the problem in barter system. Lack of coincidence of wants. Under the barter system, the buyer must be willing to accept the commodity which the seller is willing to offer in exchange. The wants of both the buyer and seller must coincide. This is called double coincidence of wants. Lack of store value. So what is lack of store value? Lack of store value refers that, see, we saw an example. I want to purchase rice from you, you want to purchase wheat from me. But in this case, if I don't purchase rice from you within a particular duration, say 2-3 months, that rice will deteriorate in its quality. Wheat will also what we can say, it will be it will be deteriorated in quality. after a particular period of time. So in case of perishable goods, there was no store value available for that perishable goods. That was the problem in barter system. Some commodities are perishable. They perish within a short time. It was not possible to store the value of such commodities in original form under the barter system. See, if we had money, what would I have done? What would I have done, Piyush, if I had money instead of barter system? I will not store that wheat, rice. I will immediately sell it off because it is a perishable commodity and I will get some money. But in case of barter system, the problem was we are exchanging goods for goods. I would have to require to store that good to sell in some quantities to some people, right? So in case of perishable goods, when they do not have any store value, there was a problem, right? Now what is lack of divisibility of commodities? See, to provide particular rice, only I have to provide you 1 kg of rice and you will provide me 1 kg of it. This is possible in case of commodities which are divisible. But in case of commodities which are not divisible, there was a problem. Like in case of animals, either I have to provide you the whole animal. So that was the problem. Divisibility was the problem. If the commodity is divisible, I could have exchanged it for that particular value. But if the commodity is not divisible, I am not able to provide that commodity, right? So that was the problem in the barter system. Depending upon its quantity and value, it may become necessary to divide the commodity into small units and exchange one or more unit for other commodity. But all commodities are not divisible. This is particularly true in case of animals. Okay. Now we will see difficulty in deferred payments. What is it? Deferred payments means what? We both, see Piyush, you and I are doing a transaction. We agreed on that transaction, but what we said, we will perform that transaction on a future date. Future date. We agreed that. You said that I will give you rice. You said you will give me wheat, but not now. You said after 2 months we will do this. Okay, on a future date. So what was the problem in the barter system? Now, if the price of rice was 20 rupees per kg and after 2 months, if that price increased to 30 rupees, you will be at a loss, right? Or either I will be at a loss because the price is increasing in future and I am giving a higher commodity to you with a lower rice. If the rice price was only 15 rupees, I am taking 1 kg of rice and giving 1 kg of wheat. So if the price of wheat is 30 and in turn I am getting only 15 rupees commodity, so I am at a loss. Now the problem was with deferred payments. So I will be at a loss in that situation. So also you might also be at a loss. See, if the price falls of wheat, frequently it becomes 12 rupees. So you are taking a 12 rupee commodity and giving me a 15 rupee commodity. So you are getting a lesser value commodity, right? So that was the problem with barter system. In case of deferred payments, if the value of the commodity changes in future, it increases or decreases, it would either lead to be a loss or loss or gain to one of the person and profit or gain to the another person, right? So difficulty in making deferred payments. Under the barter system, future payment for present transaction was not possible. Making payment in future for a present transaction was not possible. How? Because the future exchange involved some or other difficulties. For example, suppose it was agreed to sell specific quantity of rice in exchange for a goat. What they are saying? Rice for goat. On a future date. We saw, right? After keeping in view the present value of the goat. And now what we decided? You will give me 10 kg of rice for the goat. For determining on what is the value of goat or what is the market price of goat today in the market. But in future, if the market price of the goat changes when we are performing the transaction at a future date, one of the party will be at loss and one of the party will be at gain, right? But the value of goat may decrease or increase by that date, right? Now we are moving into functions of money. Money plays a significant role in the modern economic life of human beings. How? Evolution of money. The term money was derived from the goddess Juno Moneta of Rome. Money was invented, so we saw what difficulties we saw in the barter system. Lack of coincidence of wants were there, deferred payments, divisibility problem. So to reduce all this or to eliminate all these problems in the barter system, we invented money. Money was invented as a standard form of payment for transaction. Money was invented to overcome the difficulties of the barter system. Several economists define money in several ways. Robertson defined money as anything which is widely accepted in payment for goods or in discharge of other kind of business obligations. Seligman. According to Seligman's definition, money is the one that possesses general acceptability. It is acceptable everywhere for any transaction, right? Money is what money does. Now we will see 4 types of money. What are the different types of money? We will be seeing that. First is commodity money. What does commodity money mean? What are commodities? Gold, silver is a commodity, right? Then also rice, wheat is also a commodity. Tobacco is also a commodity, right? So when the money derives its value from a particular commodity, it is called as commodity money. It is the simplest and the oldest type of money. See, gold coins were there. Silver coins were there in the previous bronze coins, copper coins. In the ancient times, people used to use those to exchange in time of Shivaji Maharaj or in ancient Mughal time also. They were using money as what? Coins, right? Gold coins, silver coins, right? Bronze coins. So that type of money is called as commodity money. In the simplest and the oldest type of money, it is built in scarce, valuable natural resources that act as a medium of exchange, store of value and unit of account. Commodity money is closely related to and originates from a barter system, right? That time also there was barter system, but they were using gold coins, silver coins, bronze coins as a medium of exchange, where goods and services are directly exchanged for other goods and services. See, they are given. Examples of commodity include gold coins, beads, shells, spices, etc. Fiat money. Fiat money is what? Fiat money is the money which is printed by the government. So now today government prints various types of money, like we have currency notes of 500, 1000, 2000, 10 rupee note, 5 rupee coin, everything 10 rupee coin. So these types of money, these are printed by whom? The Reserve Bank of India, the government, right? These are printed and acceptable by the government. So everyone accepts them. So these type of money is known as fiat money. The term fiat means a formal authorization or proposition or a decree. This means fiat money gets its value from a government order. Government will a government is getting its value. It is printed by the government law and regulation. Here the government declares fiat money to be a legal tender which requires all people and firms within the country to accept it as a means of payment. If they fail to do so, they may be fined or even put in prison. So everyone, since it is printed by the government, everyone is accepting it. Unlike commodity money, fiat money is not backed by any physical commodity. Is it of gold, silver? Do we have the coins which is printed by the government of gold, silver? No. By definition, its intrinsic value is significantly lower than its face value. What face value? Intrinsic value is lower than the face value, right? If we go that note, this paper, 10 rupee note paper, is it paper, that paper on which the 10 rupee note is printed, does it have any value, that paper? No. So that its intrinsic value is very less, but the value, face value on which, face value is the value which is there on it, is more, right? If we say, if we don't, it is not printed by the government, we erase that 10 rupee printed by the government and we just use that 10 rupee paper and sell it in the market, we will get 10 rupees? No. So that is the intrinsic value. The paper which is used to produce that 10 rupee, its intrinsic value is very low than the 10 rupee amount printed on it, right? Its face value is more, intrinsic value is less. Some of the examples of fiat money are coins and bills. Now we will see fiduciary money. Fiduciary money is, see, check, bank drafts are fiduciary money. Fiduciary money means what? The payer and the payee are accepting it as a form of money. That type of money is said to be fiduciary money. That involves check, bank drafts, etc. We'll see. The term fiduciary is meant the involvement of trust, especially with regard to the relationship between trustee and beneficiary. That is why fiduciary money depends for its value on the confidence that it will be generally accepted as a medium of exchange. Unlike fiat money, it is not declared legal tender by the government, which means people are not required by law to accept it as a means of payment. Some examples of fiduciary money include checks, banknotes or drafts. Now we will see what is commercial bank money. Commercial bank money refers to any type of loan which is given by the commercial bank. It can be a personal loan, car loan, it can be a house loan, right? It can be a credit card, they issue credit card, right? So that type of credit card through which we take money, that is also called as a commercial form of money. It is described as claims against financial institutions that can be used to purchase goods or services. It represents the portion of a currency that is made of debt generated by commercial banks. More specifically, commercial bank money is created through what we call fractional reserve banking, which is a process where commercial banks give out loans worth more than the actual currency that they hold. Any type of loan by the commercial bank may be termed as commercial bank money. Personal loan, car loan, house loan, mortgage loan, that is a secured loan, like we keep something collateral and then we get that loan. It can be a credit card, right? These type of all are known as commercial money. Now we will see what are the features of money. Components of money supply. Money supply includes all the money in the economy, right? Every money type, whatever we saw previously, fiduciary money, fiat money, commercial money, commodity money, all these money supplies will form the money in the economy. The components of money supply can vary from country to country. Broadly speaking, money supply composes of the following: currency issued by the central bank, demand deposits created by commercial banks, etc. You want book? Book you want? You both can sit together. Sit with her. See, currency issued by the central bank and demand deposits created by the commercial bank. So there are two types of money. The currency which is issued by the central bank. What types of currencies the central bank is issuing? 10 rupee note, right? 1000 rupee note, 500, 2000, whatever the dollar, 5 rupee dollar they are issuing. These all types of money which is issued by the central bank is also a type of money. And the demand deposits created by commercial banks. See, demand deposits created by commercial banks means we are saving some money and we put that money in a commercial bank, or we create an FD, we create a particular FD, we save, or we have some balance in our account, savings bank account in a commercial bank. That money will also be a form of money. So adding up both these money, the money which is issued by the central bank as well as adding up the money which we have as a deposit with the commercial bank will give us the total money, right? In any country, the central bank issues currency. Currency consists of paper notes and coins. In India, Reserve Bank of India, which is the central bank of the country, issues notes in denominations of rupees 2000, rupees 500, rupees 100, 50, 20 and 10. The 1 rupee note and coins are issued by the finance department. 1 rupee note and coin are not issued by the Reserve Bank of India. They are issued by the finance department. So these are currency issued by the central bank. Now we will see demand deposits by commercial bank. Bank deposits are a prominent component of money supply. Commercial banks create credit from the primary deposits of money received from the public. Credit is created in the form of deposits called derived or secondary deposits. Now we will see money aggregate. What is the total aggregate money in an economy? First, what we saw, M1 is what? M1 is more liquid to less liquid we will be moving. M1 is the money form which is more liquid. M2 is less liquid than M1. M3 is less liquid than M2. So what are these forms? Currency. Currency is very liquid. If I give you 1 rupee, I can immediately give you, you will immediately give me that commodity, right? So currency. Next, demand deposits and other deposits. This is the M1 form. Now we will be aggregating it M1 plus time liability portion of savings deposit with banks. See, saving bank account deposits are there. We have some balance in our saving bank account. That is known as time liability portion of saving deposit with bank. Certificate of deposit issued by bank. Term deposits maturing within 1 year. See, we have a duration for deposits also which mature within 1 year, which mature after 1 year, which mature after 3-4 years, after 5 years, after 10 years, right? So which mature within 1 year are more liquid than which mature after 5 years, right? So that's why we have added up these also here. Now M3 we will add M2, term deposits which mature more than 1 year. Call term borrowings of bank. What are call term borrowings? Call term borrowings means what? Any type of loan which the bank gives is known as call term borrowings of the banks. So in India, mostly M3 is used as broad money. We add up what? M1, liquid plus less liquid than that. All these three add up, we get the total amount of money circulation in the economy, right? Now we will see value of money. The purchasing power of money is called the value of money, right? If I can purchase more with that money, my purchasing power is more. So the value of money is more, right? So it is nothing but the exchange value. It means how much goods and services can be obtained in exchange for 1 unit of money is called the value of money. If I have a 1,000 rupee note and I can purchase commodity, so which will have more value, 1,000 rupee note or an 100 rupee note? Which has a more value of money? Why? Because we can purchase more amount of goods and services from that amount of money. So that will determine the value of money. If we can purchase more amount of goods and services from that amount of that money has more value. The value of money also depends upon the price level. The inverse value of price is called the value of money. See, if the price is, why value of money and price are inversely related? See, price and value of money. See, I have a 1,000 rupee note. In two scenarios we will see. And the price is 10 rupees. Here the price is 100 rupees. So when the price is 10, price is less, what will be the value of money? How many commodities I can buy? 100 units I can buy. Right? In case 1, price is low. When price is high, 100 rupees, I can buy only 10 units. Okay. So in which case is the value of money high? In which case we can purchase more goods with the same amount of money? Case 1 or case 2? See, we have price, we are seeing the relationship between price and value of money. Case 1, the price is 10 rupees, the same amount of money 1,000. I can purchase 100 units. With the same 1,000 rupees, the price is increased to 100 rupees. Now I can purchase 10 units. So in which case, case 1 or case 2, the value of money is high. In which case we can purchase more goods? So in case 1, the value of money is high. So when the value of money is high, price is less, right? And when the value of money is low, price is high. So there is an inverse relationship between the price and value of money, because when the price increases, we will be able to purchase less commodities from the same amount of money, 1,000 rupees, right? So when the price increases, value of money falls. So there is an inverse relationship between price and value of money. Clear on this, Piyush? You all three clear? Okay. Same they have said it. The inverse value of price P is called the value of money. So there is an inverse relationship between price and value of money. Types of value of money: internal exchange value and external exchange value. So what is internal exchange value? With that 1 unit of money, that is 1,000 rupee note, we were seeing how many goods or services this 1 unit of money, that is 1,000 rupee note, many goods and domestic goods and services I can purchase, that is called as the internal value of money. And what is external value of money? With same that 1000 rupee note, how many foreign exchange or foreign currency I can buy, that is called as external value of money. How much, like we exchange, right? See, for getting $1, we have to pay 60, 70 or 80 rupees. How much is the value, right? To get that 1 unit, how much we are paying, that is the external value of money, right? How much foreign currency we can get, that is the external value of money. If I have 80 rupees, I can get 1 euro. So my value is 80 to get that 1 euro. Foreign currency to get that foreign currency, right? Clear on this? Internal and external. Internal will be how much goods and domestic goods and services we can purchase with that value of money, unit of money. And external is how much foreign currency we can get from that value of money. Types of value of money: internal exchange, external exchange. Internal exchange. How many goods and services can be obtained in exchange of a unit of money domestically is called internal exchange value. External exchange value. How much foreign currency can be obtained in exchange of a unit of domestic currency is called external exchange value. Forms of money. What are the forms of money? Cash money, credit money. Other financial assets, paper money, coins, near money, or money substitutes, which are bank check. Now we will see what is Gresham's law. Any doubt up till now? Clear? Piyush, clear? I will erase this. So what is Gresham's law saying? That Gresham's law says that in an economy, bad money drives good money. So means what? Good money is driven out of the market, that it is good money is not used for transaction purpose, but bad money is used for transaction purpose. So what does this mean? We will see in detail. See. I have a 10 rupee note and a 10 rupee coin. So now we will see which is good money and which is bad money in this case. Same, the value is same. 10 rupee note, the value is also 10 rupees, and 10 rupee coin, the value is also same, 10 rupees. So what is their face value? Face value is 10, 10. Face value of both is same, right? Face value here of 10 rupee note and 10 rupee coin is same. But intrinsic value. Intrinsic value means what? The coin is made up of some metal and the 10 rupee note is made of some paper. So which will have more value, paper or metal? If we go in the market, what is the metal's value is more or paper's value is metal. So the 10 rupee coin has more intrinsic value than the 10 rupee note. 10 rupee note has less intrinsic value, right? Even though the face value is same, 10, 10, but the intrinsic value, that is the paper or metal of which they are made, is different. Coin, it is made up of metal, so it will have more intrinsic value. 10 rupee note is made up of paper, so it is have less intrinsic value. And second thing, which will get easily 10 rupee note can be torn, right? Will it stay for longer if I use for transaction? I have both 10 rupee note and 10 rupee coin. What will I do? 10 rupee note फट सकता है भाई मेरे से, कुछ खराब हो सकता है रखने पे, ज़्यादा दिन मेरे पर्स में रखा तो फट गया, तो मैं क्या करूँगी? I have that 10 rupee note. Also its intrinsic value is also not. पेपर है, intrinsic value भी नहीं है और फट भी गया, तो what I will do? If I have same 10 rupee note and 10 rupee coin, I will give 10 rupee note to another person and keep 10 rupee coin with me, right? Logically. So 10 rupee note is of inferior quality, is not that good also of 10 rupee note compared to metal. Metal will last longer. 10 rupee note can get torn. Also intrinsic value of 10 rupee note is less, right, than 10 rupee coin. So bad money is the 10 rupee note here. And 10 rupee coin is good money. So what I will do? I will use bad money and keep the good money with me, right? Because the 10 rupee note can be torn, also its intrinsic value is less. So I will give it that to some other person and keep the 10 rupee coin with me because it has more intrinsic value, metal will last longer. So for transaction purposes, people will use bad money and good money they will keep with themselves. That is what it is saying, that bad money drives good money out of the transaction. So bad money is used for transaction purposes and good money is kept by the people with themselves. Clear? Clear on Gresham's law, everyone? This is the concept. We will see the theory now. Gresham's law. The law states that bad money drives good money out of circulation. What does it mean? Bad money drives good money means good money is not used for transaction purpose. Bad money is used for transaction purposes. This is true in case of BIML system where two metal standard gold and silver operated side by side. We took another example. In such a case, one metal currency drives another out of. See, even though if we have gold and silver coins, what will I do? Gold is more valuable. I will keep gold coin with me and I will give away silver coin, right? Which is a bad money. So which is more valuable, which is more in intrinsic value, which will not deteriorate, that I will keep with myself, and which is less bad money, which is less of intrinsic value, with of less value, I will give it to another person. More valuable I will keep with myself and less valuable I will give it away. More valuable is good money and less valuable is bad money here. In such a case, one metal currency drives the other out of circulation. It means cheap money drives out dear money, right? Cheap money means what? Bad money, which is of less value. That I will give it away to another person, and which is of more value, I will keep it with myself. If a country uses both money as well as a metal money, the people will use the paper and hold the metal. What we saw, right? We gave an example of a metal coin, 10 rupee coin and a 10 rupee note. What they are saying? People will use paper. What? Why? I will use paper because metal I can keep it with myself. It is more valuable. 10 rupee note can be torn, right? It has less paper and it's of paper. Its quality is also means it has no intrinsic value. So I will use which bad money for transaction purpose and keep good money with myself. Now we are seeing quantity theory of money. What it shows, the quantity theory of money deals with the relationship between quantity of money and price level of economy. Here we discuss the three versions of quantity theory of money. We will be discussing the three versions. Quantity theory by Irving Fisher. What it says, the quantity theory of money explains about the value of money. Irving Fisher gave an equation to determine the value of money. What he is saying is the total supply of money is equal to the total demand of money. We will see this. Irving Fisher used an equation MV is equal to PT, that is the money supply is equal to the money demand, where M is the money supply issued by the legal authority. Legal authority means who? Reserve Bank of India, government, these are issuing this. V is the velocity of money. What is the velocity of money? Anyone can tell me? What? No, that is the value of money. Velocity of money means what? See, if I have this 10 rupee note, velocity means how frequently I am using that 10 rupee note to purchase goods or services. That is known as velocity of money. How frequently I am using that money to purchase goods and services, that is velocity of money. If I am using it more frequently to purchase goods and services, my velocity is more. And if I am using it, I am not using that note to, I am not using it frequently to purchase goods or services, that is my velocity of money is less. P is the price level, T is the total output. Fisher used the equation to show the relationship between money supply and price level as direct and proportional. See, when the price level is high, the money supply will also be high. So, the money supply and price level have a direct and proportional relationship. What we saw in the Fisher's equation, MV is equal to PT, that is money supply is equal to the money demand. See here, MV is equal to PT, that is money supply is equal to the money demand. Now we will see further. The rate of change in the money supply, that is dm is equal to the rate of change in the price. Now this is important, main points. We will see how these relationships work. What we saw, money supply and price level have direct and proportional relationship. Means what? If the money supply in the market is more, there is more money in the market, the price level will also be high. Second thing is what? Money supply and value of money. And price level and value of money. What we saw? When the price is high, with the same amount of 1000 rupees, I will be able to purchase less. So my value for that 1000 decreases when the price increases. So price and money supply have an inverse relationship, right? Now we will see assumptions of Fisher equation. Velocity of money is constant. What we saw, velocity of money is the frequency with which I am using that money to purchase goods or services. So will it be constant every time? No, so this assumption is not that correct. Gross national product is also constant. This assumption is also not that correct. This theory assumes money demand for transactional purposes only. Now we will see criticism. What are the problems with this Fisher's equation? Fisher's equation is abstract and mathematical truism. It does not explain the process by which money affects P. M means what? Money supplied by the legal authority affects the price. It is presumed that either M is used up in buying T instantly. It is unreal. No one spends all the money the moment it earns. What they are assuming here is that even if I am a person and I earn 50,000 rupees, immediately I will spend that 50,000 rupees to purchase the output. Is it realistic? No. If I have earned 50,000 rupees, whatever is required for that purpose only I will purchase the output, whatever output is required. I will not spend that 50,000 immediately. Instead, I will save some part of it. So, which is unreal. The concept of full employment is a myth. Is full employment possible everywhere? There is some part which is unemployment. There is a natural rate of unemployment in every country. Now, what they are saying? Even with full employment, a country can increase the national output by bringing those factors which are not available within the economy from abroad. So even there is full employment, the national output can be increased. Why? Because even if we don't have those factors of production available with us, those raw material, whatever which is required for production of that output, we can import them from other countries, right? And increase our output, right? Right, Piyush? Now next what they are saying, it is presumed that money is used for transactions only. Hence the theory is often referred to as cash transaction theory. This ignores other roles of money. Money can be used for other purposes also, no? Right? So it is called as cash transaction theory. Now we will see quantity theory of money. Cash balance approach or Cambridge equation. Let's see this one. Are you clear? See, simple. Fisher, what he is saying is that money supply is equal to money demand. When the price increases, value of money is less. Inverse relationship. Money supply and price, proportional relationship. Money supply is high, price is also high. And one more, what they are saying, money supply and value of money. So whatever will be the money supply and value of money, there is an inverse relationship. Now we are seeing quantity theory of money, cash balance approach or Cambridge equation. Cambridge University professors give another equation which explains the value of money. What they are saying? M is equal to PKT. Money supply for a M is the money supply for a specific period of time. P is the price level. K is the cash balance. And T is the output, total output. Now we'll see. However, Fisher's version and Cambridge version of quantity theory are not exactly same. They are different. What is difference here? We will see. There is a small difference. The total transactions in the market, see, T is not equal to Y every time. See, if I am purchasing some commodity, will it be that commodity is produced in this year only? It can be the production of previous year, right? So whatever I have purchased can be a production of last year also, and whatever I have total output that I have purchased this year, will it be sold this year only completely? No. So the total output for that year and the total amounts of goods purchased for that year, will they both be equal? No. So that only they are saying here. See, the total transactions in the market in a year T may not be exactly the same as the total output of the year Y. Why? One reason for this is that all the output of the year may not come to the market in that year. Right? It may not come to the market in that year. Some might be stored. On the other hand, a good sold in a given year may not have been produced in that year, right? It might be of the previous year. It may be an unsold good of the previous year. If we ignore these differences between T and Y, that is T equal to Y, then a comparison of the two equations, MV is equal to PT and MV is equal to KPY, what it shows? That the velocity of the money and the cash balance are inversely related. Why? We will see this. Why? What we saw, velocity of money is what? How frequently I am using that money to purchase goods and services is the velocity of money. cash balance is the amount of money that I have with myself, right? See, if the cash balance is high, I have more desire. If the cash balance is high, what does it mean? I have more desire to save rather than to purchase. So, when the cash balance is high, my desire will be to save more rather than to purchase. So, the velocity, that is the frequency with which I am purchasing goods and services, will be less. So, the velocity of money K and the velocity of money, cash balance K and the velocity of money are inversely related. Clear? When my cash balance is low, my desire will be not to hold more cash but to purchase goods and services. So, when my cash balance will be low, the velocity will be high. Clear? Clear, Piyush? So, there will be an inverse relationship between cash balance and the velocity of money. That is what this quantity theory of money tells us, that there is an inverse relationship between cash balance and velocity of money. See why they are also given this here. This is because of the fact that greater proportion of income is kept as cash balance with the public. My desire will be to save more, to keep more cash rather than to spend more. So, the velocity of money will fall and vice versa. Thus, the Cambridge K and Fisher V are the reciprocal of each other. Hence, 1 by K can be taken to be the velocity of circulation of money. Strictly speaking, of course, we should distinguish between T and Y. What we saw? Total output produced and total purchase will not be the same, because it can be that we have purchased output of the goods of the previous year, and it can also be that total output produced for this year will not be sold completely in this year. So, we should distinguish between T and Y. Therefore, V is the transaction velocity and 1 by K is called the income velocity of money. Why 1 by K is the income velocity? Because it is the cash balance which we have, right? It is the cash, so it is our income, so income velocity. And now we will see quantity theory by Keynes. काय झालं? काय म्हणत होतीस? Quantity theory of Keynes. What it says is that money supply and interest rate. It is showing the relationship between money supply and interest rate. We will see what is the relationship between money supply and interest rate. Case 2, two cases we will see. Case 1, case 2. Money supply and interest rate. See, when the money supply is more in the market, means what? People have more money. Money supply is more means what? People have more money in their hands. They have more purchasing power. They will demand more. Right? So, at that time, what will the government do? Will they keep the interest rate high or low? See, if we keep the interest rate high, what will again happen? They will not borrow more. So, if they don't borrow more, they will not purchase more. If they keep the interest rate low, what will happen? They will borrow more. Again, more money in their hands will again increase. Money supply will again increase more. And they will purchase more. So, what we should do? The interest rate should logically be less. If the money supply, see, there is an inverse relationship between money supply and the interest rate. Money supply increases, rate of interest will be reduced. Money supply is less, rate of interest will be high. That is what this is trying to tell quantity theory of Keynes. According to J.M. Keynes, the money supply affects the rate of interest. When the money supply increases, rate of interest will be decreased. It leads to increase of investment, level of employment, income, demand, price level, etc. See, when the interest rate is decreased, what will happen? People will borrow more, they will get more money. So, the demand in the market will increase, right? When the price level increases, there is decrease in the value of money. According to Keynes, the rate of interest plays a dominant role in determination of value of money. Keynes is saying that rate of interest plays an important role in determination of the value of money. According to Keynes, the Keynesian version of quantity theory integrates monetary theory with general theory of value. In broader sense, the term inflation refers to persistent rise in general price over a longer period of time. See, we know inflation. What is inflation? The prices of goods and commodities are increasing. Why they are increasing? This happens because the demand is more in the market. Board. Okay. This inflation occurs why? Inflation means what? The price of goods and commodities is high. This occurs because what? The demand is high. And compared to this demand, the supply in the market is low. So, the demand is high, supply is low, so the price of goods and services is increasing, and so there is inflation. So, now what we will do to control this inflation? We will reduce this demand of the people. How we will reduce this demand? Interest rate, borrowings. We will make the interest rate high. So people will not borrow more money. If they don't borrow more money, what they will do? They will not get more money. If they don't have more money, they will not demand more. They will demand less. We will reduce the demand in compared to supply to control the inflation. Clear? Now we will see definitions of inflation they are given. Crowther defined inflation as a state in which the value of money is falling and that the prices are rising. Price is rising. So due to that price, with the same 1,000 rupee note, I will be able to purchase less goods and services. So the value of money will decrease when the price rises. So there is an inverse relationship between price and value of money. According to Samuelson, inflation denotes a rise in the price of general price level. Now we will see causes of inflation. What are the causes? We will take some causes now. Primary causes. Let's see guys, causes now. What are the primary causes of inflation? See, when the demand for the commodity in the market exceeds the supply, exceeding demand will push up the price. That is called as demand pull inflation. So what is the main reason for inflation? Piyush, what is the main reason? Demand is more, demand is less. What is the reason? Than supply? No, not interest rate. Now we were talking reason for inflation on the basis of only demand and supply. We will keep aside interest rate. Interest rate is not into picture now. Demand and supply. What is the reason for inflation? The demand is more, demand is less than supply. That's why we have inflation. When the demand is more, supply is less, what will happen? The price of commodity will increase. So persistently, when the demand is more, supply is less, price will go on increasing, and this will lead to inflation. So that is called demand pull inflation. When the demand is more than the supply, the price increases. Persistent increase in the price of goods and commodities will lead to inflation. So that is known as demand pull inflation. Next is cost pull inflation. See, when the prices of raw material or the labor or other factors which are required to produce that good increases, what will happen to the price of the good? Will the price of good increase or decrease? Common logic. If I am using a raw material of 100 rupees previously, now its price increased to 200 rupees. Will I increase the price? Commonly, logically, to recover that amount, I will increase my price. So when the raw material prices, wages or other factors of production which are required to produce that good, their price increases, naturally the price of good which I am selling in the market will also increase. That may also lead to inflation. So that type of inflation is known as cost pull inflation. When the cost of other factors which are required to produce that good increases, the cost of this good also increases, and so the price increases. So this is cost pull inflation. And demand pull inflation is what? When the demand is high but the supply is low. So that increases the price. So that excess demand leads to price rise, and that price rise leads to inflation. Now what we are seeing is increase in public spending. See, commonly when there is an increase in the public spending, what does it mean? Demand is less or more? When there is an increase in the public spending, common people are spending more money, will the demand in the market be more or less? More. So again the demand is increasing than the supply. Again that is causing the inflation when people are spending more. See, increase in public spending. Government spending is an important part of total spending in any modern economy. It is an important determination of aggregate demand. In less developed economies, government expenditure has shown an upward trend. This has created inflationary pressure on the economy. Next, deficit financing of government spending. What does deficit financing mean by the government? Okay, fine for today. How many pages are left? Deficit financing नंतर करायचं ना आपल्याला. ठीक आहे, झालेच आहेत. 5:37 is so done. Okay, thank you, bye. We will continue tomorrow from deficit financing. Any doubts we will clear. You can go home and revise. We will clear any doubts if you have. Okay, you can feel free to ask me doubts tomorrow. Okay, goodbye.